Sonal, thanks so much for having me on the show. So if you go by SEBI definition, it says that 80% of your investments in an ELSS fund has to be in equity or equity linked instruments. So either you can have 80% directly in equity, or you can have some portion of that in arbitrage, because that's also considered as an equity linked instrument. But there are very few funds who actually have that 80% in equity. Most funds in this category have 95%, close to 95% in equity. There are very few funds who actually take the cash call, or probably use that available bandwidth of 20% in fixed income. But largely, if you see the entire equity allocation, whether it is 80% or 95%, both the categories that we spoke about, is largely mid cap. There is very little 10 to 20% in small and mid cap. Everything else is large cap. My apologies. So this is very similar to how a large cap or a flexi cap fund ideally operates, Sonal.
Okay, got that. We'll talk more about ELSS funds. Kirtan, thanks for joining us. But just some data with the new tax regime being announced. I mean, it's very clear, right, that the government is pushing for this to be adopted as the main tax regime. But what have the flows looked like ever since this did come into play?
So Pavitra, if you look at since 2021, the flows have only increased. So the total mobilized flows in ELSS in 2021 was 3,175. 21-22 was 3,783. Last year was 4,922. So it's only moved up. Of course, this year we've seen that this new regime has been made as a default. But the first quarter is too small a time frame to actually compare whether, because it's moved to default, whether it's going to have an impact or not. But since the time it was actually made public and people could choose between actually not gone down as such, right? But if you still have to compare this year's first quarter, where the new regime is made mandatory or default, versus last year, the funds have fallen by close to 8%. So the first quarter last year was roughly 4,922 crores of mobilized funds. And this time around, the first quarter is 4,542 crore. So that's a small 8% dip, but this is too early days, I think, to understand whether or not, because the new regime is made default, whether there is going to be a fall. But since the announcement, the mobilized funds have not really dropped in this category.
Okay, so there is not much impact that we're seeing on the category despite the announcement of the new tax regime. But the key advantage, of course, remains that it provides the tax benefit to any investor. What are some of the disadvantages of investing in an ELSS fund?
Sonal, largely, look, there are no advantages as such, but if we still have to highlight some points, I think there are 2 points that immediately come to mind. The first is the 3-year lock-in, right? Because you're going to take tax advantage, you can't redeem out of these funds till you clear the first 3 years of the lock-in. So that's one thing that we can definitely talk about. But largely, look, this can be a blessing in disguise for a lot of people who are not very disciplined with their investment. And the second is that though the fund has the flexibility and can move across large, mid, small, wherever they really want to, and there is no SEBI definition of where and how much do you have to keep in large cap, mid cap, and small cap. Still, this fund is actually a pseudo large cap. You look at across category and you will know that 75-80% of the equity allocation that happens in this fund is large cap. So though it can have the flexibility of a flexi cap fund, it still operates like a large cap fund.
Yeah, I think that's an important point to highlight, because a lot of times you could see an overlap in your portfolio. If you a large cap fund, you're looking at an index fund, then you go ahead and pick an ELSS scheme as well. So you should definitely keep that in mind. But Kirtan, so if someone has decided that, okay, they want to look at an ELSS scheme and they want to get in, what do you think they should check before choosing? Because there are so many options available even within this space.
So Pavitra, the first thing that I would definitely suggest is not look at the last 3 years of performance and decide which scheme do you really want to invest in. But if you want to go into some minor details or how to pick a fund, what we typically do at our end is look at some 4 or 5 things. First, we look at the objectivity of the fund, whether do they take cash or not. What I mean by that is 90% of the funds or schemes in this category are funds which don't take cash calls, which means they have 90, 95, 98% investments in equity. But there are a couple funds which, depending on the market situations and valuations, they go to as low as 80% equity and keep that 20% as cash. So first you will have to check whether or not the trying to invest in, it follows what? Does it take cash call? Does it not take cash call? One. Second, you should also look at what style of investing is the fund following, right? Is the fund following growth style of investing, value style of investing, momentum, blend? Because you want to make sure that when you onboard an ELSS scheme onto your portfolio, right, you also want it to bring in the diversification flavor versus the other schemes in your portfolio. Third, very importantly, I think what you should look at is it a pseudo large cap, like I was mentioning, or the fund actually plays or is flexible to take mid cap and small cap bets? If it is pseudo large cap, then you have to understand that you are actually onboarding a large cap scheme, and whether or not do you have large allocation to large cap already or not. What you also can look at the top three sectors in which the fund is investing, but very importantly, look at the index. It should not happen because this is a so large cap, this is kind of largely mirroring a large, because then it does not bring in a flavor of active to your portfolio. Once you've looked at these basic things, I think you can definitely look at the risk adjusted performance of the scheme, like the rolling return or the Sotino or the information or the down capture ratio, to try and understand whether or not historically on a rolling risk adjusted basis has the fund been able to do well in various cycles.
Okay, usually most of the ELSS investments are done in a lump sum fashion. Does that really matter versus the SIP route, since the money is going to be locked anyway for 3 years?
Sonal, this is a tricky one, and I'll tell you why. Because I'm not a very great fan of doing SIPs in ELSS scheme, because like you rightly pointed out, so today if I do an ELSS SIP on the 1st of August, right, only the units that I make from this investment on the 1st of August will be redeemed in 2026 of August. So if I do an SIP, only every monthly SIP is what I'll be able to redeem after every 3 months. And hence the lock-in is more than 3 years in that sense. But when you try to lump sum, you are actually trying to, kind of time the market, because you are putting that entire 1.5 lakh rupees at one point in time. So it's slightly a tricky one, but I would say that as a retail investor, because you would not know or you would not want to time the market, you might as well spread this investment across your 12 months. But I think another way of looking at it is that you look at the last 40 years of data, and every year, intra-year, the market gives you more than 10% fall from the highs, right? So if you are slightly a disciplined investor and you see a 5, 7, 8, 10% fall from the intra-year high, you might just want to allocate that.
Okay, got that. That makes it easy to pick which way, and I think everyone can take that call for themselves basis, how educated they are within the markets. But not just on ELSS, but also the solution-oriented fund approach to, saving on taxes. We're going to talk about that, but first up, we have to take a short break over here. Stay tuned. We'll be back in just 2 minutes to continue our chat.
This is the newest pin code in town. This is the latest address of the diamond industry in India and the global markets as well. This is the largest office in the global markets. The place is 9 big buildings, 15 stories each, and offices are as small as 300 square feet to as big as 1 lakh square feet as well. So it clearly is a congregation of everybody who's working into diamond industry, from makers, polishers, cutters, manufacturers, jewelry makers, exporters, importers of diamond, polishers, cutters. So this place houses them. Plus, there also is banking, financial services, custom clearance, all of that. There are nearly 4,500 offices inside, which are all the construction began.
Welcome back. You're still tuned into MF Corner on CNBC TV18. We have with us Kirtan Shah, Managing Director, Private, all about tax-saving mutual funds. Kirtan, a lot of ELSS money gets churned in 3-year cycles. So is this a good way to approach it, or should this be treated like any other long-term investment?
Sonal, I think that's an interesting one because honestly, I would like to play it from a longer-term perspective. Because for me, ELSS typically replaces a large cap kind of orientation or objective to the entire portfolio. But while you try and rechurn every 3 years, I think there are two problems that you end up taking. First, while you're trying to sell, right, there can be a tax component, maybe higher or lower, but there is definitely a tax component that you will end up paying because you are trying to sell and then rebuy again. And also, while we are trying to reinvest again, we are taking reinvestment risk. Is because when you sell, it'll take 2-3 days to come to you down. And in the meanwhile, if the markets run away, typically we've seen retail investors then think that let me wait. Once it'll come down, I'll buy it. And then it runs away in a rally one time, you will actually end up liquidating that asset and not investing. So I think you should treat this as a long-term investment. Let it replace the large cap side of the portfolio that you are trying to build. Because if you don't do it, you will either end up taking taxation risk or reinvestment risk.
Okay, that is helpful. But Kirtan, my next question to you is on passive ELSS schemes. Now, what has been announced is that AMCs can launch passively managed schemes if they do stop their fresh inflows or subscriptions into whatever current existing actively managed ELSS schemes they do have. What is your take on this, and do you think this is something that will pick up significantly?
Pavitra, if you go by whatever has been happening over the last couple of months or a year since the time this was announced, AMCs have not really come out to offer the. They'll have to actually stop taking active investments in the active scheme, and then they are allowed to do the passive. Which is why out of the 43, 44 odd ELSS schemes available today on the active side, we've not really seen AMCs stop the active and come up with passive. One. But if passive can really become a play for the newer entrants or AMCs which does not have ELSS to offer, and also over a period of time, we have been continuously saying that this really replaces the large cap side of the portfolio. If AMCs don't really use this more from a flexi standpoint and they are only going to replicate large cap index or trying to only play the large cap play through the ELSS, I think over a period of time, passive will definitely become a play because large cap schemes we've seen on the active side have not been able to do great in terms of performance when it comes to be able to beat the benchmark. So currently, we've not seen the existing guys come. The newer guys, I think, will come up with more passive options.
Okay, so our viewers would like to know that. Any ELSS fund recommendations for them?
Sonal, this will depend on a lot of other things of what you really have in the portfolio, but one, Kotak and the Canara Robeco.
Okay, those are some recommendations that you can look at if you are looking at this category. Kirtan, the other space where we talk about tax saving is the solution oriented funds, right? Whether it's children's funds, retirement funds. Now let's talk about the children's funds first, because these also come with a tax benefit. Do you think that this is a category that everyone with a child should consider, or do you think you can just try to save that corpus through a regular equity fund?
Pavitra, I am somebody who believes the latter one is more sensible. Okay. I have two reasons to agree. While you are trying to invest in a solution-oriented fund, 5 years or before you are 10, 18 years of age, right? So I'm not really a great fan of doing lock-in kind of investing, one. And second, because the solution-oriented funds, specifically the child plan that we are talking about, is hybrid in nature. Now, if you are going to have a very long investment horizon, and if you're going to have 35-40% of your investments which are going to be parked in debt because this is a hybrid fund, right? You are typically going to miss out on the larger compounding advantage that you otherwise could have generated because you had 10-12 years of investment horizon. But because the nature of the fund was hybrid, you had 40% of the investment parked into fixed. So I'm somebody who believes that if you have 10, 12 years of investment horizon and you have a little risk appetite, you might as well want to do it through direct, equity options than doing hybrid or solution oriented.
Okay. So when we talk about retirement funds as well, is it something that you would recommend to your investors? Something that makes sense for most people, or would you prefer saving for retirement via a different category?
Sonal, again, very honestly, my answer to this category is also the same that my answer to children's fund was. Why do you want to lock in when you have options and the freedom available, right? Second is, even after 5 years of lock-in, a lot of these funds have very high exit loads, right? And the third, like I said, these are hybrid categories. And if I really want to invest for 20, 30 years, right, I will want to do my asset allocation separately and not invest in this fund and let the fund do the asset allocation. So any hybrid category which has such high lock-in period, and also then there is going to be an exit load if I want to redeem it before I really mature the money, I would rather stick to doing asset allocation on my own or investing in direct equity funds than going through the solution-oriented funds.
Yeah. No, I definitely get your point there that, if you do have this kind of time horizon, which you most likely do for, children's or a retirement fund, you might as well try to be a little bit more aggressive within whatever, capabilities you can manage. Kirtan, moving on to the next question is on debt-linked saving schemes, because this has been a long pending request of the industry. It hasn't come out yet, but do you think that this is potentially a good idea?
Pavitra, if you go by what communication comes from the regulators or the ministry, is that they want to, kind of bring all kind of products at par, and which is exactly why we saw that indexation on debt mutual funds was taken away. Now, if that's the communication that is going around option, right? So if parity is what we are talking about, then definitely mutual fund also should have an option where you have debt-linked investments that can be done, and if you do 5 years of investment, you can get the ATC benefit.
Exactly what the entire industry has been. Very interesting chat on tax-saving mutual funds, on ELSS, what children's funds or maybe a retirement fund could also offer you. Thank you for joining us today, as always. And on that note, we're going to wind down in this edition of Mutual Fund. Remember to take you through the final hour of trade today.